Global markets are currently in a correction phase under the dual pressures of geopolitical conflict and rising inflation expectations. Investors are focused on two core questions. When will this pullback bottom out, and will the 2020s replicate the stagflation pattern of the 1970s? In its latest weekly report, BofA Securities offers its assessment. Signals of a market bottom have partially emerged, but conditions for stabilization are not yet fully met. In the base case, the 2020s are more likely to trend toward inflationary boom rather than 1970s-style stagflation, with the key variable being the Iran situation and the path of oil prices. Meanwhile, NVIDIA's withdrawal of $1 billion AI investment may signal that the period of exponential growth in AI capital expenditures is beginning to slow. BofA notes that this correction was triggered by the external shock of the Middle East conflict combined with prior excessive market optimism. 4 conditions are needed for the market to stabilize, 2 of which have already been met. First, oversold assets like software, mags, private credit, bank loans, and Bitcoin have begun to bottom. Second, overbought assets like gold, semiconductors, metals, emerging markets, European stocks, and bank stocks have seen profit-taking. Fund flows confirm this. Gold saw its largest weekly outflow since October 2025 at $1.8 billion, while energy saw its largest weekly inflow ever at $7 billion. The capital structure is rebalancing. However, 2 key conditions for stabilization remain unmet. First, oil and the dollar, both safe haven assets, have not lost buying support and show no clear reversal signals. Second, the S&P 500 has not fully price corrected. It has yet to break below key support, meaning the cleansing process is insufficient. Meanwhile, BofA's bull and bear indicator remains high at 9.2, firmly in extreme bullish territory, indicating market sentiment has not truly cooled, capping any rebound potential. BofA stresses that until the dollar's trend becomes clear, expectations for a sharp rebound are premature. The dollar index is a core gauge of global liquidity. A decisive break above 100 would reinforce expectations of tightening liquidity, further compressing the Fed's room for rate cuts in 2026. The market's probability of a June cut has already fallen from 100% at the start of the year to 37%, and could trigger curve flattening and an inflationary oil shock. On fund flows, U.S. stocks saw their largest outflow in 6 weeks at $13.9 billion. Japanese stocks saw their largest weekly inflow since October 2025 at $4.2 billion. Korean equities were particularly volatile, with a record $6.1 billion inflow on March 2nd, followed by a record $4.7 billion outflow on March 4th, a sign that capital is trading extremely short-term amid geopolitical uncertainty. On whether the 2020s will replay the 1970s stagflation script, BofA argues that while the 1970s are the closest historical analog, there are fundamental differences. In the base case, the 2020s are more likely to trend toward inflationary boom rather than stagflationary collapse. Supporting this view, rising global populism, tariffs and immigration policies altering globalization, sustained fiscal expansion, a accommodative Fed stance, and the too-big-to-fail nature of equity markets driving asset and wealth inflation. These factors will fuel inflationary pressure, but government intervention will cap bond yields, ultimately manifesting as a weaker dollar rather than persistently rising long rates, favoring commodities, real assets, international stocks, and small caps. BofA traces the full stagflation path of the 1970s. Easy policy from 1970 and 1972 drove stocks up over 60%. The 1973-1974 inflation shikong and oil shock crashed stocks 45%. The 1975-1976 inflation pullback sparked a rally. The 1977-1980 Iranian Revolution triggered a second inflation wave, sending stocks down another 26% until Volcker's aggressive tightening ended the era. Translating to today, the core variable remains the Iran situation. If the conflict is brief and oil stays below $90, the inflationary boom logic holds. If the conflict becomes protracted, the Strait of Hormuz is blocked, and oil breaks $100–$120, asset allocation would shift to oil, the dollar, U.S. tech, and defense, with oil importing markets like Japan, Korea, and Europe under the most pressure. Year-to-date asset performance already reflects this pattern. Oil up 30%, gold up 18.3%, commodities up 22.6%, the S&P 500 up a meager 0.3%, and Bitcoin down over 16%. Meanwhile, a significant shift is underway in AI investment. NVIDIA has clarified that the previously announced billion-dollar OpenAI investment is not in its plans, and the current $30 billion financing arrangement may be the ceiling. This is seen as an early signal that exponential growth in AI capital spending is slowing. Buffet notes that the peak in software ETFs coincided with NVIDIA's September 2023 investment announcement. The withdrawal of those plans could now be a key catalyst reversing two major trades, shorting tech bonds and going long semiconductors while shorting software. Software also has high Liandong with private credit and bank loans. Bank loan funds saw their largest outflow in 3 months this week, at $900 million, with bank loan ETFs approaching a critical credit event threshold. Key technical supports for market stability are software ETFs, holding $80, and bank loan ETFs, holding their previous lows near $20. In summary, the global market correction has not yet fully bottomed. Stabilization requires a reversal in the dollar and oil, and a full price cleansing in the S&P 500. The probability of a 1970s-style stagflation replay in the 2020s is low, but the Iran situation and oil path will determine the ultimate macro picture. The slowdown in AI capital spending adds further pressure for structural market adjustments. Investors need to dynamically adjust allocations based on geopolitical developments and fund flows.